Imagine you had to build your investment portfolio from scratch in 2026. No individual stocks. No trying to pick the next big winner. Just 4 ETFs that could provide diversification, long-term growth, and a simple strategy to stick with. Today, I'll show you the 4 ETFs I'd choose and how I'd structure the portfolio using a core and satellite approach. The idea is simple. Your core portfolio provides stability and broad market exposure. Your satellite investments aim to boost growth by targeting specific sectors or opportunities. A common rule of thumb is 80% core, 20% satellite. This helps reduce risk while still giving your portfolio some extra growth potential. First up is VAS, the Vanguard Australian Shares Index ETF. VAS tracks around 300 of Australia's largest listed companies. That means you instantly own a tiny piece of many of Australia's biggest businesses. Some of the major holdings include banks, mining companies, healthcare leaders, and consumer brands. The biggest advantage, diversification across the Australian market with an extremely low management fee of just 0.07%. If Australia grows over the long term, VAS lets you participate without trying to pick individual winners. Next comes BGBL, the BetaShares Global Shares ETF. While Australia has great companies, our market is heavily concentrated in banks and mining. BGBL solves that problem by investing in around 1,300 companies across developed markets outside Australia. This gives investors exposure to global giants across technology, healthcare, industrials, and consumer sectors. The management fee is only 0.08%, making it one of the lowest cost ways to gain international diversification. Personally, I'd make this the largest part of the portfolio. Now for the satellite position. NDQ tracks the NASDAQ 100 index, which includes many of the world's biggest technology and innovation companies. Think Nvidia, Apple, Microsoft, Amazon, and Alphabet. Technology has been one of the strongest long-term growth sectors globally. Of course, higher growth often comes with higher volatility. NDQ does have a higher management fee of 0.48%, but many investors accept that cost for focused exposure to innovative businesses shaping the future economy. This would be my growth engine. The optional 4th ETF is GHHF. This is an all-in-one, globally diversified ETF with a twist. It uses moderate gearing, typically around 30 to 40%. Gearing means borrowing money to increase investment exposure. When markets rise, returns can potentially be amplified. But when markets fall, losses can also be larger. GHHF may suit investors comfortable with higher risk who want a diversified portfolio without having to manually rebalance multiple ETFs. If I were building from scratch, my portfolio might look something like this. 30% VAS, 50% BGBL, 20% NDQ. Or, for investors wanting a simpler solution, GHHF could become an attractive all-in-one alternative. The exact percentages can vary depending on your goals and risk tolerance. So there you have it, 4 ETFs. I'd seriously consider, if I was starting my investment journey in 2026, VAS for Australian shares, BGBL for global diversification, NDQ for technology growth, GHHF as an optional all-in-one geared solution. Remember, investing isn't about finding the perfect ETF. It's about building a diversified portfolio, keeping costs low, and staying invested for the long term. Which ETF is your favorite, and what would you add to this portfolio? Let us know in the comments below. If you enjoyed this video, don't forget to like, subscribe, and hit the notification bell for more Australian investing and ASX content. Thanks for watching, and I'll see you in the next one.